We've had a phenomenal run of late in the market. It's been one of the best 3 and 4 month runs of all time. We're now roughly at 5,000 on the S&P 500, which is a phenomenal feat and decently into new all-time highs. However, I have reason to believe that there is reason for us to see some chop here. And I'm not saying go short or anything, but what I am saying is I do think that there is going to be some reemergence of the fire and ice idea that Mike Wilson put out at the end of 2021, which led him to be considered, and he received some notable awards for the best analyst of 2022, and led our fund to have a historic year in 2022, up over 120%. So I'm seeing some similar things now that I did then. Some at least reasoning, not to as obviously an extreme extent, but it is present. And I find it something to be aware of. So if you have large positions that could be exposed to some of these ideas, maybe it's wise to consider realizing some of those gains and ringing the register on some of those gains after you have had such a strong run. So let's take a look at what caused this run. What caused this run was from October, because we were in a little bit of a downtrend prior to that, was this notion that the Fed had pivoted, that we were in this new phase, essentially, of Fed policy where easing was just around the corner, and we were going to get back to 2019 kind of vibes, 2019 kind of Fed policy, and things would be all good. That, however, does not necessarily seem to have come to fruition. The market has almost certainly gotten well ahead of itself in terms of the Fed expectations, and we've spent the past several weeks trying to walk that back. In the bond market, to some extent, mostly in the Fed futures market, however, very little in the stock market. Yet, that reasoning is what seemingly has propelled the market to have its best 3 and 4th month periods of all time. And typically these, big double-digit moves in the market, when they're this strong, they occur from the lows. I'm talking like a recession from the bottom. That didn't necessarily happen here. Yes, we had a little bit of a pullback, but strong move. Post-recession, immediately type move. And, that would have made sense from October to be on there to 5,000. Very strong levels, all-time highs, with a totally different interest rate picture and long-term interest rate picture, which we can get into as well. So in the last video, we talked about one thing Powell said, this question he posed. What does that mean for the neutral rate? The idea that the economy was strong and interest rates were much higher. What does that mean for the neutral rate? He just kind of said that as he was answering a question. It wasn't part of his prepared remarks. But since then, we've heard several Fed members talk about how the neutral rate may possibly be higher. Several of them have said that verbatim or close to verbatim, something like that. They've discussed this idea. That is a very big question. I'm not sure if it's something we need to worry about yet, but what does matter is when you're talking about the Fed, or the market was talking about the Fed, having 6 interest rate cuts this year, if the neutral rate is higher, you don't need to necessarily cut as quickly. There's just a higher end game. The amount of total cuts is going to decline versus when you have a 2% neutral rate. But if you look at the Fed dot plot, the neutral rate has been trending up, and it's looking like it's somewhere close to 3%, between 2.5% to 3%. So that's a little higher. That's a lot higher than we've had over the last decade plus since the great financial crisis. So the expected Fed action hasn't come to fruition, and now we are starting to see a little bit of the bumps in the road with inflation. Nick Timiraos the so-called Fed whisperer, said today that forecasters, people who are, taking the information from the CPI and the PPI, putting it through their equations or whatever, getting expectations for PCE, and that's the Fed's preferred inflation gauge, are now seeing the highest month-on-month read over the last year, 0.4%. I think that was for non-core. But that leads us to our next moderate concern. Obviously, the Fed likes to exclude food and energy. But they don't totally ignore it, and energy is not without an impact on the broader price level as a whole. So, over the last month, we've seen a 10% increase, or not even the last month, last few weeks, we've seen a 10% increase in the national average price of retail gasoline from $2.99 to $3.29. That's notable. And that could continue to go up. Seasonally, it's expected to continue to go up. And we saw, obviously, pretty large gasoline inventories after we saw pretty large oil inventories. Now we're seeing the opposite, or opposite in terms of WTI, because there's a little bit of a build as refineries are offline, but it's an interesting picture, that's all I'll say. That inflationary trend could continue. This might not necessarily be just a blimp. Like I said, that data point, that 0.4, highest in the year, that's for January. Now we're talking gasoline, we're talking oil in February. It's not impossible for these trends to continue into March, April, and May. And if you have that, you have what should be a scared market. The market should be a little rattled by that. I get it. Inflation is technically good for stocks, but should be a little rattled by a pickup in inflation. Oil is seemingly the one area of the entire world that hasn't benefited from inflation in terms of nominal levels. That is partially because we had artificial supply. We had the Strategic Petroleum Reserve, which was put out. That coincided with the highs. And then it was extended twice, I believe, beyond what was anticipated then. Now that's done. Now they're refilling it. Not saying refilling it is, some great thing. They're not doing it at a rapid pace. But it's not going down, which is a good thing for oil companies that are being judged on their profits and revenues. So, that leads us to the final kicker. Today, Barkin of the Virginia Fed, I believe, said that the January data for the economy was messy. We saw the retail sales, and that is not necessarily so good. That could continue as well. If you get this continued trend in inflation, which could be aided by economic weakness, which may be beginning to appear, you could get things to cool down. You could get the Fed to cut. You could get interest rates to not get out of hand. But here's the problem. Here's the paradox. The market is currently expecting earnings to start really reaccelerating. Some 10% growth this year, I think, something like that. I don't know if you're going to get that if you're getting economic weakness in January that maybe continues into February, maybe continues into March and April, and doesn't necessarily reverse. Unemployment that begins to pick up a little bit. So, there are things that I think are concerning. The market has had a tremendous run, one of the greatest of all time. And I do think there is a little bit of a fire and ice paradox present. So that's how I'm looking at things. I have obviously learned my lesson in big ways over the last year, trying to short the market when I felt like it was appropriate to do so. We had a phenomenal move from some of the biggest bank failures ever on a market that misanticipated the Fed. I have a written piece about how I said that expectation of the Fed, which ended up being very true, except not the market reaction, was one of the biggest market dislocations I had ever seen. That part was true. The market response was not. We had a phenomenal year last year in stocks after that point. So I've learned my lesson with shorting. I'm not saying to do that. What I'm saying is if you have longs, probably a good time, in my opinion, to take some gains. Although I'm not saying I'm going to be right. I'm very long oil. I'm all the way in. And I'm very long, small, speculative companies like Jumia in Africa and some of the CRISPR stocks. And that's how I'm positioned. So, that's today's video. And until next time, peace out. And feel free to ask any questions.